Hey everybody, my name is Johnny, and today I'm going to be talking about the importance of saving for retirement early on in life so that you can have a comfortable retirement at the end of your career, and additionally, just how easy it is to do that and how much that's going to help you out in life. So, to get started with that, the easiest way for most of you to do that is going to be through a 401k. That is an employer-provided plan which allows you to set aside a percentage of the money you're making from each check before you even pay taxes on it and put it into this plan so that it can grow over time. Now, I made a video touching on this a few weeks ago, and I'll go ahead and put the link in the description, and you can watch that and see the different type of retirement accounts and how they work. This one is going to specifically be about a 401k and the specific range of investments that are normally included in there. So to get started, you'd have to be able to set up your account, and you have to do that with your company's website. So you go to your company's website, and you click on their benefits section, and if they provide a 401k, it will be in that section, and you click on the 401k plan, and first it's going to ask you how much of a percentage you want to put inside of this account. Now, I myself would suggest at least 5 to 10% of each check, because the more money that you're putting in, especially the earlier on, that's going to give you a larger amount to invest, and it's going to give you more time to build over the years. So again, the younger you get started and the more amount that you can put in, the better, of course. Now, this is obviously up to your own judgment, and obviously you need to have enough left over to pay and provide for everything else in life. But again, like I said, I would suggest at least 5 to 10%. Now, the really cool thing about this is that it's coming out pre-tax, so you have a larger amount to invest initially. And yes, at the end of your career, when you begin withdrawing from your 401k, you will have to pay taxes then. But by that point, because you've had this length of time and this larger initial investment to build upon, you'll have a higher amount of money than you would have if you were to be taxed immediately. Now, that is very much depending on your tax bracket, but since most people are going to be retiring and having a low tax bracket because they're not considered in the workforce anymore, this is how it's most often done, and that'll put you into a lower tax bracket and mean that when you get taxed, it'll be a lower amount of money being taken away from your overall investment. So the specifics of how to do this is, like I said, you go on your company's website, you click on benefits, you click on the 401k plan, and you set aside a percentage in there. Once you've determined the percentage that you want to put in there, another really cool feature about this is that the employer will often match that percentage. My employer, for instance, matches 5%. That means that if I'm getting a $1,000 check, 5% of that, so $50, is automatically being put aside in this account, and they're giving an additional $50 to match that. Now, that's free money given to me by my employers to build over time in this account. You can't beat that. That's just an incredible opportunity to be making money without having to do any additional work for it. So absolutely take advantage of that if your employer does provide that option. Now, once you've gone ahead and set all that up, it's going to ask you, what would you like to invest in it? Now, this completely depends on your specific employer's plan, but most of them will give you a large range of mutual funds which cover stocks and bonds. Now, of these, you're going to have two specifically different types of investment plans that are either actively managed or passively managed. Actively managed means that there are people who are going to be charging fees so that they can pick specific stocks and bonds for you. Passively managed, or index funds, means that they're just going to follow a large range of different companies and bonds and invest in those over and over again, and it will just follow whatever the market's doing. Now, of these index funds, you have ones that follow the S&P 500, which is the 500 largest and most predominant stocks all across America. You're going to be having ones that track the NASDAQ, that track the Dow Jones Industrial Average. So you have a lot of different room there to decide what you'd like to invest in, but typically speaking, the idea is that the more stocks that you're invested in, the safer it is because they'll average each other out through good times and bad. Now, the reason that I specifically suggest one that tracks the S&P 500 is, in addition to its safety, it has over time averaged about a 10% return per year in the past almost 100 years that it's been around. Now, once you throw inflation in there, that might drop it down to 7 or 8%, but still over time, that'll add up to a lot of money. Now, let me just give you an idea of how compound interest works. Compound interest is this brilliant, amazing concept that can be put into practice in this way. And what it means is that if you have $100 and you're getting a 10% return on it, that means that $100 is turned into $110. Now, the 10% on that will not be on your original 100. It'll be on the total 110. And each time that it builds, it continues to build on the last return that you received. Now, I don't have a calculator with me, so I can't give you any specific numbers, but I'll go ahead and I'll put a link to this site called moneychimp.com, and I'll go ahead and put the link in the description, and you can click on it and play around with different numbers, and just to give you a basic idea of how much money you could be saving and making over time if you were to put, say, $4,000 or $5,000 a year into an investment option that tracked the S&P 500 index, and you let it grow over 30 to 40 years, ranging between 7 and 10%, that would give you at least $1 million by the end of a 30 to 40 year career. Now again, there's so much variation in this because it depends on what specifically the stock market is doing when, how often you're putting money in there, and how much money that is. But again, that's just an average normal amount to give you an idea of what you can be looking at the end of your career. So I really hope that you take advantage of this and start doing this early on, because again, the longer period that you have to grow this money, the better. Now, like I said, I personally suggest index funds because they're safe, they're very easy. All you do is click a button and they do all the work for you. And the other reason for that is that they charge very little to no fees. Now, a lot of these actively managed mutual funds means that they have a manager whose job it is to pick out different stocks and bonds for you. Now, they're charging a fee for that, and their fee was going to be anywhere from 1 to 2%. Now, that's not 1 to 2% of the overall. That's 1 to 2% of that 10% return that you could be getting. Now, John Bogle, who is the founder of the Vanguard Investment Group, who actually made index funds available to the public for the first time, he did the math on it, and he says that if these managers are making 2% of that 10% return, it may seem like you're only getting a fifth of your money taken away right off the bat, but over time, that adds up to over 70% of your overall money being taken away from you by the end of 40 years. So in other words, if you're having that fifth of the money taken right off the top, that's going to compound and work against you in over 40 years. That'll be over 70% of your money gone. So I highly recommend doing the passively managed funds for their simplicity, for their ease, their safety, and for their lack of fees and or very, very small fees. That's pretty much going to be wrapping up the video for today. I really hope that you guys enjoyed it, and I'm also going to throw out a disclaimer saying that I'm not a licensed investment advisor. These are all just my opinions and what I think is best. Now, before I wrap up this video, I'm just going to give a quick shout out to my wife, who's an ambassador for the Pura Vida company. The Pura Vida company is a company that makes bracelets and sells them and distributes them all over the world. And you can go ahead and buy these bracelets using the link in the description. And the link is going to be DelaneyLang20, and if you use this link when you go to the checkout, you're going to be getting 20% off of every single bracelet. So anyways, I really hope that you guys enjoyed this video, and I really hope that it helped you to understand exactly how this works and how important it is to be saving and investing money from an early age. Alright, until next time.